Zuber, one rental at a time. It is August 23rd, Tuesday, August 23rd, and this is your daily financial news. First thing we need to talk about is the 10-year note. Yesterday, the 10-year note crossed the psychological barrier of 3%. It had been below 3% since its peak earlier in the year at 3.49%. Haven't checked mortgage rates this morning. It wouldn't shock me if mortgage rates tick up slightly as we move forward for the rest of the year. In addition to the 10-year going up, the dollar has started to re-strengthen. It had fallen back over the last 10 trading days or so, but started to pick up steam Friday, a lot more yesterday. Euro, right? We're trading below $1. There's a lot of things going on. Remember, the strong dollar hurts lots of folks. First off, if you, the consumer, the traveler, you want to travel, it certainly helps you. But if you are investing in companies who collect revenue overseas, it hurts earnings. Taylor, our Monday expert, shared with us one time an interesting fact. For every 1% rise in the dollar, there's a 50-cent hit to the S&P 500 collective earnings, right? Kind of a ratio. So watch out for that. Also, though, the strong dollar really, really, really hurts emerging markets. As the dollar strengthens, and it very likely could, as the Fed continues to raise the funds rate, we need to watch emerging markets. I'm sure you have seen what's going on in Sri Lanka. That is only one of multiple countries. You see, emerging markets, right? There's kind of first world, second world, emerging markets. Emerging market debt is most often denominated in dollars, right? Because the emerging markets currency isn't strong enough. It isn't deep enough. It doesn't have the faith of the rest of the world. So they denominate their debt in dollars. Now, as the dollar gains strength and these other emerging market currencies weaken, it quickly becomes unattainable and they can't pay back their debt. We have to watch emerging markets. It's one of those areas out there that's front and center as the dollar gets stronger. Next up, I've asked some stock traders really what happened, right? Friday, market rolled over. Yesterday was a very painful day. Near as I can tell, one person's opinion, or maybe a collection of opinions synthesized into one. Wow, can't say that word. What it appears is people are starting to believe the Fed. What I mean by believe the Fed is they're going to take rates higher, longer. If you look at Wall Street, they were essentially betting that the Fed would not raise all 3 times the rest of the year. There is now pretty consistent bets that it'll be 50 basis points in September, 25. Total being 100 for the rest of the year. Then there is general agreement that they will raise again in early 2023. But that's where the change seems to happen, because historically they have been calling for a cut, not a pause, a cut in 2023. There is now, if you look at the odds in the bets, they're no longer a cut until maybe late 2023. So I think what is happening is Wall Street is recalibrating earnings, recalibrating PE multiples, because again, we saw PEs collapse and we actually saw earnings come in over the last earnings period. So near as I can tell, I think that's what's going on. On the earnings fronts, we had a couple today. Dick's Sporting Goods beat top line, beat bottom line. What does that mean? It means top line means they sold a lot of sporting goods. Beat bottom line means they made more money than they were planning to. And they raised guidance for the second half, kind of a triple beat. Palo Alto Networks, the best of the best in the security business. Beat top line, beat bottom line, raise guidance, and 3-for-1 stock split over at Palo Alto Networks. Zoom missed top line, beat earnings, lowered guidance. Folks, Zoom posted a single-digit growth. This is not the high flyer that once was. They're now a kind of low growth company. Again, missed top line, didn't produce as much revenue or sales. Hit bottom line, managed expenses, lowered guidance. Not good. Macy's beat top line, beat bottom line, but lowered full year guidance. I think we're going to start to see that pretty consistently in retailers. We have Dollar Tree, Dollar General later in the week. We will see what's going on with retail, but I think there's a general concern for the consumer. In addition to that, I believe we get Toll Brothers and Intuit after the market closes today. Tomorrow, we get NVIDIA, Salesforce, Snowflake, and Box. Thursday is Dollar General, Dollar Tree, Gap, Affirm, and Dell. And of course, on Friday, we get Jerome Powell. Will he be the ultimate dove who says we are at neutral, which no one believes? Is he going to come out and say we're going to raise 75 again and again and again? Is he going to be a hawk? We will know. I believe he is talking at 10 a.m. Eastern on Friday, so 7 a.m. Pacific. Housing recession. I am starting to see, as I'm sure you are, more and more articles saying we have entered a housing recession. If you watch my channel, you know we've been talking about that for quite a while, and I've actually turned it into a housing depression. Folks, we did 6.9 million transactions last year. We are down to a run rate of 4.8 already, and I believe going lower. We have seen new builders whack single-family home development, and it will go lower. If you are in the real estate business and paid commission on transactions, buckle up, Buttercup. It is going to get rocky. The housing recession is here, if not worse. This will take years. The Fed broke the housing market. We have demand destruction and supply destruction. It is like nothing I have invested through. Near as I can tell, it's very similar to the early 80s. I was not looking at real estate in the early 80s. I am old, but not that old. So again, it is an interesting time to own and look for deals. I want to, again, encourage you. This is not a time to rush. It is not a time to overpay. Be patient, learn your market, understand your buy box, write good deals, ask for closing costs, know your numbers. You could still, it's always a great day to do a great deal. Your opportunities to do great deals go up when the market slows down. Not every seller, and in fact, I would argue currently, most sellers are not motivated sellers. Most sellers listening today have wish pricing on their brain. That is not where a deal is made. You do not make deals with wish pricing. Days on market needs to grow. The fact that days on market was 14, 1-4, is bonkers, crazy. I can't believe it was 14 2 months in a row. We need inventory to grow. We need days on markets to triple or quadruple. It's going to take time. Real estate moves so much slower than everyone wants. Wages and inflation. I read an interesting article from Goldman Sachs. Goldman Sachs says real wages have been negative for the last couple of years. You and I have talked about the difference between nominal and real. Good news is Goldman Sachs believes that flips the other way as soon as December of this year, if not Q1 of next year. What does that mean? That means wages finally grow faster than CPI. So either wages go up, CPI comes down, combination of both. but wages at Goldman Sachs is calling for wage growth in real dollars, not just nominal 6% with 8% inflation, which is a -2. This is important because my thesis for the next 3, 4, 5 years is we need real wage growth to slowly build back the structure and affordability in the housing market. Job cuts. So we're starting to see some of these come around. Ford Motor Company announced 3,000 job cuts just yesterday. There was a survey done of public companies. 50% of employers expect some job cuts in the next 6 months. That is pretty significant. On a good note, Americans have $21 billion, $21 billion in unused gift cards and store credits. That is a big, big number. Anything else I got for you today? Nope, I think that's it, folks. Again, this is your daily financial news. We try to do it 7:30, 7 days a week. I hope you enjoy it. Like, subscribe, comment. Today's Tuesday. We are going to be talking with Matt, Dion, and Beth, our newest expert. So I hope you have a wonderful day. We certainly will at one rental at a time. Bye-bye.